Risk management is one of those things that are going to keep you long term in the game. And unfortunately, most people get it wrong right here. All right, so make sure you watch till the very end and I show you the mistake that most people make, and so that you can avoid making these mistakes. And eventually, you're going to become a consistently profitable trader if you can avoid these mistakes. All right, so let me just share with you right now without wasting much of your time. What's the first thing? The first thing that most people do is over leverage, right? They use so much leverage such that they end up hating themselves. All right. So what's the problem here? Most people usually use excessive leverage, which of course magnifies their potential wins and of course their potential losses, right? So for example, let's say you have $100 and then you're using a 1 to 2,000 leverage. Like some brokers will offer up to that much, right? And then guess what happens? You'll be tempted to use like one standard lot on $100 account. And guess what? That's like very like maybe 3 or 4 pips against your target, against your trade, and you've lost all your $100. Why? Because of too much leverage. However, I can say, what if it goes in my direction? Right? You can make a lot of money, of course. However, the chances of that happening is quite low because on a trade by trade basis, the outcome is very random and no one knows what's going to happen with 100% certainty every time. Therefore, it's much better you use a small leverage, which is going to increase the chances of you surviving long term, unlike gambling it all away. All right, so make sure you know how much you are risking in terms of capital, and also know how much leverage you're using so that you can actually trade with a balance. All right, so what's the impact here? Small, like I've said, that's a small move against you can easily wipe your account. So to avoid doing that, make sure you're using a leverage that is actually very, very good for your account. Maybe like 200, 100, even that is actually a lot, right? So if you look at some of the brokers nowadays, especially prop firms, they're actually offering like 100 maximum and up to 50. Others actually go up to 30 leverage because they understand that more leverage can actually hurt you. So very, very important, especially if you're trading your own capital, make sure that you go with a little bit of lesser leverage because it's going to less expose you and your account, which is going to increase the risk of ruin. So make sure that you avoid this mistake if you want to actually last very long in this game, right? So make sure that you know exactly how much you're risking per trade, and also make sure that your leverage is actually in accordance with your account. All right, so let's go to the next right here. So the next you can see from here is that the next mistake that most people make is the over risk per trade. This is very common, especially if you have a small account. Especially most of our friends who have like $100, they have a $50 account and they want to flip that account, right? So most of the time, you find that they actually end up like risking 50% or actually the whole account in one particular trade. And these are the ones that are actually prone to over leveraging, which is really, really gambling, right? It's gambling because you're risking your whole account per trade. And what do I recommend here? We recommend between 1% to 2% of your account. And if you're using this, it's going to ensure that you are in the long run, you are active in the game and you're going to remain in the game for the long run. And like trying to wing it and then thinking that you're going to just make money on that particular trade. So by risking 1 to 2% of your account, this increases the chances of you actually staying long in the game. Okay, and then what's the impact of risking more than 2% per trade? It means that there's a high chance of you depleting your account in just one trade. However, you know that it's okay for you to take 3 4 losses in a row as long as you are respecting your risk management and you'll be able to last long like that. Okay, what's the solution to this? Have a fixed risk per trade. Understand exactly how much am I willing to lose on this particular trade. And if you can do that, trust me, you are going to be very calm. First of all, you're going to be very calm when you're taking a trade because you understand exactly how much you are risking on that particular trade and you know exactly how much you're standing to lose if that trade goes against you. So the first thing you have to do is before you even take a trade, go to any position size calculator and put in your account size, put in the number of stop loss, put in the amount of money you are willing to lose on that particular, either money or percentage, right? And it's going to calculate for you, and it will show you exactly how much you're going to actually be using as a lot size on that particular trade. And it will also show you the risk per trade on that particular asset. So before you even take a trade, you must be able to accept the risk of that particular trade not working out, so that you remain calm as the market goes in a direction. Otherwise, you'll be checking your trades every minute, which is never the right thing to do. So make sure you know exactly how much you're willing to lose on a particular trade and accept it. It's very important. All right. What's the third mistake that most traders make? Failing to use stop losses. So, like I always say, a stop loss has two roles for me. One, it helps me from losing a lot of money. And number two, it actually helps me invalidate my trading setup. So if I'm planning to sell at this supply zone, my stop loss is just above there. So if the market comes to that particular supply zone and takes me out from there, that simply means my trade idea has been invalidated and there's no need of me being in the market. All right. So I've been my whole idea, my thesis has been invalidated. Therefore, I don't need to be in the market. There's no need for me to be in the market. And that's the power of the stop loss. And it also prevents me from losing a lot of money on a trade, because at any particular time, guys, you can have like some big random news can come, anything can happen, and the market can just go like that and can go with a big candle against you, and you don't have the stop loss. And by the time you're thinking of closing the trade, the market has already gone, and guess what? You'd have lost your whole account and a lot of money, which is really bad. Make sure you are always using a prop. Against anyone that says I don't use a physical stop loss. I have a mental stop loss somewhere there and everything. I don't encourage that. If it works for you, well and good. But if you are really looking for my opinion, always use a stop loss and have a fixed stop loss in the market, so that when the market comes to that area, you know that you're supposed to get out, right? So what's the impact here? The impact here is that the market can reverse at any particular time, and this can result in a very big loss. So make sure you avoid all that by simply having a physical stop loss in place. All right. And what's the other one? So what's the solution to all this? Always use a stop loss and have a logical place or and on a technical level. And this is very important. So place the setup, place that stop loss at the logical level based on technical analysis and market structure. So for me, for example, my stop loss is going to be below the low or above the higher high, right? Because that's where I know that once the market reaches those levels, it means that my setup will be invalidated, and that's the reason why I'm going to be out of that particular trade. So it's very important, and I recommend having a stop loss in place anytime, any day. All right. Then ignoring the risk reward ratio. So it's really sad to see others who have a negative risk reward ratio. It is really mind boggling, right? So it's really important for you to make sure that you are trading with a strategy with a positive risk reward ratio. For me, really, I want you to have at least 1 to 5 risk reward ratio. Don't trade with a 1 to 1. It will be very difficult for you to become a consistently profitable. It means that you have to win a lot more trades, right? So many traders enter into trades with poor or negative risk reward ratio, such as risking $100 and trying to make it $50, right? I mean, it doesn't really make sense, right? So if you've been following, for example, our strategy, you realize that we have a higher win rate, a higher risk reward ratio. So it means that even if I lost 7 out of 10 trades, and those 3 trades that I'm going to win, those are going to bring massive profits. So it's all about what you're comfortable with. Others are comfortable with having a higher risk to reward ratio and lower win rate. Others want to have a higher win rate and a lower risk to reward ratio. So for me, I go with lower win rate and significantly higher risk reward ratio. So it's all about what you're comfortable with and everything. All right. So what's the impact of having a low risk reward ratio or a negative risk reward ratio? It means that with a higher win rate, even with a higher win rate, you still lose money at some point, because it will take time for you to be able to actually like make money. You need to have like extremely higher win rate in order for you to do this. So make sure that you have at least a 1 to 3, 1 to 4 risk reward ratio. So make sure that you aim at least 1 to 3 and higher. This is going to be good for you on the long run. Otherwise, having a negative risk reward ratio can be really, really, really tricky. So it's really, really important that you do your back testing of the strategy that you want to use, and make sure that you are certain about these numbers right here. Okay, and what's the fifth important mistake that most people actually make? They make emotional based decision based on fear, greed, revenge, and take impulsive trades, which will lead to over trading and holding on to losing trades. This happens every time and again, because we're emotional beings. You take, maybe the first trade was a loss, you take the second trade, it was a loss, and then in the next trade you be like, "Okay, forget about it, right? Forget about risk management. Let me go all in and actually make back all the money I've lost." This is a recipe for disaster, because no one knows what's going to happen on a trade by trade basis. So in order for you to avoid all that, make sure that you are calm whenever you're taking trades. You are following your strategy every time. Have a pre-planned system where before you even take a trade, you've already forecasted that particular trade, and you know exactly what you're looking for in the market. And once the market has come to your area, you execute that strategy flawlessly, without hesitation, without fear, because you understand that that setup has met your criteria. And if you do that, you're going to actually minimize emotional trading, because you have a rule-based system that tells you when to enter a particular trade and when to stay away. If you don't do this, you're going to find yourself fighting greed, FOMO, revenge trading, and these are going to keep you in a vicious cycle where you keep blowing your accounts and funding your accounts, blowing your accounts and funding account, and that's really, really crazy. All right, you guys. So I really hope that you actually got something from this. Remember, always have a plan. Make sure that you are always waiting for the market to come to your area. Always have a positive risk reward ratio. Never take a trade that has a negative risk reward ratio. That's not a way to win, guys. And then always use a stop loss in the market. Have a stop loss that you are actually going to be taken out if the market goes against you. Make sure that you are not risking not more than 1 to 5, not more than 1 to 2 risk reward ratio, more than 1 to 2% per trade, guys. Make sure you know exactly how much you're risking. I recommend between 0.5 to like 2% maximum per trade, and make sure you are consistent with that every time. Number one, avoid over leveraging. It can work, of course, in your direction at some point, but in the long run, it's going to hurt you. All right, you guys, I really hope you found some value in this video. If you have, make sure you subscribe, like the video, or comment in the comment section. Let me know what is the mistake that you've been actually falling for among these 5 mistakes. All right, you guys, I hope you found value. Until next time, goodbye.